We brought you the results of a Bloomberg survey earlier saying investors buying benchmark 10-year notes will only gain about 1% in 2011. This is once interest payments are reinvested. Joining us now with a little bit more on the outlook for the new year is Bloomberg best economic forecaster LeBas. He is the chief fixed income strategist at Janney Montgomery Scott. He's in Philadelphia this morning. Guy, thanks so much for joining us. We're appreciative of it. So Wall Street's biggest bond traders saying investors in U.S. government debt are barely going to break even next year. What do you make of that view?
Well, I think there are two things. First of all, the bull market that's dominated bonds over the last decade has come to an end. And that's as much a feature of the fact that rates are at absolute lows than anything else. It's number one. Number two is the idea that rates aren't going to spike up instantly. And the increases in interest rates that impair the market price of fixed income instruments isn't going to be severe enough to overcome that periodic income that those same instruments pay. So it's not the end for all bond investment over the next couple of years.
Yeah, but as you mentioned, I mean, many people point to this fact that, yields are climbing back from their lowest levels since the 1950s. I mean, we're back to some pretty extreme levels.
Well, yes, absolutely. And, anytime you start from this absolute low level of yields, any type of increase looks significant. But one thing to note, I think, is that over the course of the last 4 weeks, although interest rates have risen, inflation expectations, which we really see as the biggest long-term driver of interest rates, have remained relatively stable. So there's not a lot of inflation risk being priced into the bond markets, and we see that as a positive for stability into the new year.
Guy, look into your crystal ball. I mean, how are you positioning yourself, the advice you give to your colleagues, to clients for the new year?
Sure. We're positioning to take advantage of a continuation of what we call the risk-on trade. The idea that additional investment dollars are going to be flowing out of the super safe assets, for example, Treasury notes, and into slightly riskier assets like corporate bonds, municipal bonds, and also the high-yield sector. We expect high-yield corporate bonds to be the best performer of 2011.
So that's what you're looking for a big theme. To put you on the spot yet again, what is the Fed going to do? Any moves in the first 6 months?
Well, we don't expect the Fed to change their policy on interest rates at any point in 2011. That's likely a 2012 occurrence. I think the focus is really going to be on QE2 and whether to expand or terminate the program as scheduled in June. Our analytics kind of suggest that QE2 should be scaled to about $1 trillion to $1.25 trillion in order to have the needed effect. So if inflation numbers month over month keep falling, I think the Federal Reserve has a greater chance of expanding QE2 than they do of contracting it.
Guy, thanks as always. Guy LeBas joining us there from Philadelphia. Janney Montgomery Scott, he is a Bloomberg best.